I thank Dr. Famba for providing us with the relevant information, which we are going to use it for the relevant reading material and lecturing material, which we are going to use today, which is very critical. So we are going to look on the preparation of financial statements. Like what we said last time, our financial statements consist of a statement of comprehensive income, which is the trade and profit loss account, a statement of financial position, which we can call balance sheet. You've got statement of cash flow statement. You've got statement of change in equity, and we also need notes which are relevant. So these are very important financial statements which an entity or an organization is supposed to present to the users of the financial statements when they are required. So this is guided by the standard called IS1. IS1 is guides the preparation of financial statements. So today I want just to look on the simple presentation of financial statement of a sole trader. The sole trader, from the background, that's the person usually operates alone, is an individual. That's a sole trader. So we will start by statement of profit or loss for the year ended 31 December 2021. This is a sample from SOCO. Last time from the lecture which I uploaded on the group, we were preparing the trial balance. So when we prepare the trial balance, we need that information on the trial balance plus notes related is going to be used, is going to be transferred again to the next stage of preparing the statement of profit or loss or statement of comprehensive income. For example, what I'm saying last time, I still remember when we were preparing the trial balance, so that's supposed to know. So I hope everyone is now aware of the trial balance and how the trial balance is used, can be used, and so on. So let's go on the first one. What we need to understand here, we've got revenues. That's the first thing we're supposed to do. Revenues, we are saying when you're talking about revenues, normally these are income generated in the ordinary course of the business of an entity. To say, for example, if you are in the field of selling motor vehicles, your revenues are from the sales of motor vehicles. Anything other than that, maybe disposal of the motor vehicle which you don't want to, which is no longer in use, that is not a revenue, not regarded as a revenue, but usually we calculate a gain. Okay, so revenues, how do we calculate our revenue? We go to N1. N1 here, revenues consist of sales. When you sell, then you have what? Revenues here. Then after selling, you've got what? The revenues. Then you've got returns. Sometimes there are customers who might need to retain some of the goods. For example, if somebody had purchased 8 cell phones, might realize that one of the 4 cell phone is malfunctioned, not working properly, then that customer might retain that cell phone, which means that cell phone is a return which reduces our sales. Let's say if our sales were 21, let's say our sales were 21 here, were 21. If you are saying maybe, let's say Toki has got 10, a system here is 10, let's say 10 here, it's sold 10 cell phones, Toki. Then there was a return from the customer, maybe a customer called Melus retained 2 cell phones, which means that let's say the value of those cell phones were $10 and the returns were of $2, because usually you should measure this in monetary monetary form when you are presenting our financial statement with the money measurement concept. Money measurement concept, that is what we are saying. We use what the monetary concept. So it means here the total revenues at the end of the day, they are reduced by the returns. Then it's 8. Because why they are 8? Because we have what? We have mainly retained some of the goods worth $2. In accounts, we say this should be disclosed, not to just write 8 as sales directly. This is not allowed. We should do disclose these returns, and sometimes we need to investigate what are the major causes of those returns. Then cost of sales, opening inventory. Then after this, usually, if you want to go deep, you cannot just sell goods before you incur what you incur some costs. Usually, because you also go and order from suppliers. So when you go to the supplier will sell the goods to you. So on this one, these are expenses which are going to be incurred by the business. So that is very, very what critical. It's very important to notice that. It's very, very, very critical for us to understand that we incur also what we also incur expenses. But for us to generate revenues, for us to generate these revenues, we need to incur expenses. Then you go to cost of sales. The cost of sales consists of opening inventory. Let's say here the opening inventory which was in the stock was $1 here. Then the purchases during that period, then maybe we purchase goods worth $14. Then carriage in, what we call carriage in, those are the amounts, the money usually, which is paid and bring what you bring the items, the assets into use or into sellable conditions. For example, if you purchased a good from a dairy board, you need to transport those milk products from dairy board maybe to your company or to your bottle store, or to your supermarket. If you buy from Delta, you buy beer from Chibuku, the same thing, you pay some carriage inwards usually. Or if you go and buy maybe a motor vehicle in Japan, or to go and buy a motor vehicle in SA, South Africa, there's a carriage amount which is supposed to be paid. So they say it's also one. Then you go to returns. Sometimes we can also return our goods with the what? So it's subtracted, because sometimes we return outwards. Maybe from our purchases, some of the goods worth $2, they are not they are not in good condition. So we return them. So the returns, they reduce the purchases. They reduce the purchases and cost of so those returns outwards. Or this is the returns outwards. Then you've got good available for what? For sale. So here the goods available for sale becomes 1 plus 14, 15 plus 160 minus 2. In account, this bracket, they mean minus. So don't get afraid, or don't find yourself to be in a very wrong position. We don't understand what we mean by this bracket. It means we are subtracting. Don't write a subtraction sign at the jargon of account. So here is 1 plus 14, that is 15 plus 1, that is 16 minus 2, that is what? 14. So 14, that is the 1 plus 14, 15, 15 minus 1, 14 plus 2, that is 16. Because 1 plus 14, that is 15 minus 1, 14 plus 2, that is 16 here. Then closing inventory. Sometimes you find out in an organization, there are some goods which might remain in the stock at the end of what? Of that one, December 2020, let's say 2023. Yeah. You find out there are some goods which are going to remain in the inventory. Let's say the goods remain in the inventory. It's what? It's 3. Let's say it's what? It's 3. But let's say it's 1. And this then cost of goods sold. So cost of goods, you say opening inventory, which was although in the stock. Visually, this one is recorded by the date. For example, 1 January 2022. Then when for the A ended 1 January 2023. So which means that on its own, which means that the opening inventory, that is the amount which is there at that particular day when you are opening our trading year. But it becomes a closing inventory for the previous what year. So the open inventory is for that is guided by the date or by aware that the closing inventory for the previous year, for that one December 2022, the open inventory was 2,000, which means that becomes what my open inventory for 2024. Then you've got goods what for sale, cost of goods available for sale after you've done all these. That is closing inventory, 16 minus 1, then comes cost of goods. On this situation, our cost of goods becomes 15 here. Comes 15. So these are critical because this one they control, then they make sure that the organization can smoothly move. And if you know these revenues and the cost of what, so whether they keep on of the very, very key elements for an organization to maximize profit or make profit when necessary. Then let's go on the next one. What we are saying, let's go on to depreciation. Let's go on before we do that. Where are we saying depreciation? Okay, there are some costs which might appear there, which might not what appear there. So what you need to do, when you ever incur a depreciation, when there's a depreciation. Hello? Or before we go further, any question on this? Any question? Can you admit your friends, please? They are on the log. You can admit you've got those rights and powers. Any questions? Any question before we move further? Any question, class? Okay. Hello, any question? Hello? Hello, class?
Yes, we are here, sir.
Any question?
How do you calculate the cost of sale?
Hello?
No, we don't have any questions.
Okay, thank you so much for calling, Kamban. Okay, let's go on to the next year. We can also calculate depreciation. Depreciation, usually an asset. When an asset is being used in an organization, the assets incur some expense in the form of depreciation, whereas out the depreciation is provided by the company, so that at least we are making sure that that asset is being appreciated for the work it is doing, and that depreciation should be charged in the profit and loss account. It should be debited there. So depreciation sometimes it depends on the company. Some companies they've got the straight line method of depreciation. Some they've got using balance method of depreciation. Some also they've got some of digit depending on the organization. But this should be to follow a proper international financial standards when you are dealing with what depreciation. So when you look at the non-current assets, we said non-current assets, these are assets which can be used for more than one period. Or should be used for more than one period. What do we have here? Motor vehicle, computer equipment, fixed and fittings, and total. But if you have cost accumulated depreciation, then the current charge should have cost, then because a motor vehicle is depreciated, so you are going to be given the accounting policy which is used by the company or the accounting estimate to say they are depreciating motor vehicle straight line method, or the depreciating computer equipment at maybe they can say maybe computer equipment that need to be taken care of, fixed and fitting investment properties. So those are some of the what which appear on the non-current assets. Then current assets, you've got the assets which can be used anytime within what? Within which does not even invite current assets usually. They don't invite, they invite fraud, corruption, and so on. So that's why usually cash is supposed to be banked easily. So you've got cash, bank, account receivables. Then you've got the prepayments. They are there, some of the what of the assets. Then you go on to the next.
Attendance apamuta kuenda sei tekoni tinokwana muhoo tato 15.
Okay, sorry, I got a call. There was an emergency call. Let's continue. I was talking about to say cash bank. Usually, an organization is being encouraged to bank money as soon as possible. It should be cash, because these are very tempting. Account receivables, possible adjustment in inventory, the figure of close towards inventory prepayment. So the account receivable, these are debtors. The people who always ask. Sometimes we cannot allow customers to borrow from us, then they will pay. That is the account receivable. Inventories, the same thing. So these are the key elements which you're supposed to understand. Prepayments, for example, the ZESA, maybe it's now $26,000 per year. So then you paid 27,000, which means that you paid an extra of what? 1,000. So that 1,000 becomes a what? A prepayment, because they paid for something which is not used. So it becomes what? A prepayment. Let's go to the statement of financial position. we've got equity and liabilities. Equity, that's the amount which you've invested as an entity. Liabilities, you've got an obligation to settle in the near future, and both in the near future. You need to, if you've got liabilities, it's an obligation, you should pay that amount in the near future. That is the liability. For equity, the owner's resources, capital. You've got capital here. Sometimes, if it is a company, the equity can be presented in ordinary words, share capital. Then net profit, then drawings. Drawings is whereby a person or the owner of the business is taking the money or stock, even stock for personal use. But those are drawings. So drawing, they reduce the capital. That's the rule. Drawings reduces capital. You don't have money, but when you own and what, you take the money. If your relative just arrived, then you go and then you go and take cooking oil in the shop, in your shop. It's a drawing. It's not allowed in business, whereby you just go and take money or take stock to send somebody to say, go and been given 2 kg of sugar because you don't have. Then you've got long-term loans. Long-term loans, these are loans which are supposed to be paid maybe after 12 months, to be settled after 12 months, or a trading period. These are long-term loans, include debentures, mortgages, so on. Non-current liabilities. These current liabilities, they should be paid within 1 year. For example, trade payables, this should be paid within 1 year. That is what we call current liabilities, accrued interest. That because trade payables should pay your creditors in time so that you can continue borrowing. Then what you pay within that 1 year. Then we got other accruals. Then interest payable, accrued interest, and other accruals. So these were some of the highlights. So when you come to the main format here there was this one, operating expenses. Operating expenses, advertising, sometimes given, bank charges, garage outwards, delivery expenses, wages and salaries, rent, electricity and water, repairs and maintenance. These are expenses which are we incur. So before we go to the next slides, I want the floor to give the opportunity to the floor.
Hello, sir. Hello.
You was going to say I saw Pamutere.
Oh, sorry, hello.
Okay, I have a question on drawings. How do we calculate drawings that are withdrawn as goods? Do we calculate the selling price or the purchase price? Thank you.
Okay, thank you so much for giving me that to say how do you drawings, they reduce purchases. They reduce 2 accounts, purchases and what? Capital. You understand? Because they're purchasing, so what you do, they should be their cost price. What you have invested, you have invested $20, and that $20 you purchased stock. Then you want to please your friends or your relatives. then you spend that $20,000 instead of investing that into the business. So it reduces the 20,000 which you have invested capital. Then you go and vis-a-vis purchases. You don't reduce sales, but reduce what? Purchases. Because our purchases, they are at a value of what? At value of the cost price. Are we together on that?
Yes.
Yes,
Because
sir,
our
thank you.
Okay. Another question, the interaction is very critical.
Fair.
Any other questions? Any other questions? If we don't have other questions, what we can do, we go and we will do the practical work of a person which are going to do together. And I need your attention on this on this practical work. That is very, very critical. It's very important for you to make sure that you listen. Let me take the one. This one.
Kuna wakawanda. Kuna wakawanda.
Yeah, vakatongwara zve nokuti haisitesi. I'm to try to upload the what I want to share with you. So once I upload, those who were using their videos, can they remove their videos? Hello? Hello?
Hello.
I think
Hello?
the slide.
Hello, sir.
I think the slide.
Yes.
Yes, we are seeing it there.
Yeah, I can see people, yeah, they've got enough network today. Some they're enjoying posting their pictures, but can you please try to minimize that? I know some of you, you might need your friend to see you, that you are still alive and you are fit. So that's commendable. But our system does not allow that. If we do all videos of us, so let me go to this one. You need to have a ballpoint pen and a paper so that we do this question together. The question which we are going to do is about Toki. Who is going to read for us? Who is going to read for us? Any volunteer to read for us?
Yes.
Yes, you can continue.
I think the slide is not showing Toki statements.
Let's go. Anyone to read for us? No, any volunteer. Anyone?
Let me
Example
try.
one.
Okay, you can read.
Example one for key sole trader. Capital 82,887. Sales
Capital.
200.
Okay, thank you. We'll go one line by line. Then you say capital. Where do you present the capital? Where do you present the capital? In the statement of financial position or in the what you call a balance sheet. So I will say statement of financial position or a balance sheet. Then sales.
I think sales
Trading
in the
account.
trading account.
Here and and it. Let's say profit trading account. Yes, that's good. It's a trading account, but in our document P and what? L. That is P and L. Next. Trade accounts payables. Trade accounts payables. Account payables, sometimes they can be written as creditors. Sometimes they can be written as creditors. Where do you write them? English. Yes? It's what? Statement of financial position. Return outwards. Yes, the liability. Thank you. Return outwards.
Trading accounts payable.
What? Return outwards.
Profit
P and L. P and L. Allowing for doubtful debt.
Profit or loss.
That affects profit and what? Loss. Discount allowed.
Profit or loss.
Profit or loss. Discount received.
Profit or loss. Account payable.
Purchases.
Profit or loss.
Hey, order. Order, please. Order. Purchases.
Profit or loss.
Profit or loss.
Return inwards.
Profit or loss.
Return outwards.
Profit or loss.
Profit or loss.
Drawings.
Statement of
Draw.
financial position.
Statement of financial position.
SF.
We said drawings reduces what?
Reduce capital.
Reduce what? Capital.
Capital.
So one reduces what? Reduces capital. It reduces capital here. Carriage inwards.
Profit or loss.
Profit or loss. Under trading profit or loss account or what? Trading, it goes under trading account or? Carriage inwards.
Trading account.
It goes under trading account or under operating expenses.
Profit or loss.
Trading inward, carriage inwards.
Trading account.
I think,
Loss.
but it goes trading account.
They go under trading account.
Come in. Trading account. That's trading account. People, they've got a problem here whereby they take carriage inwards, then they take this carriage inwards, then they put them on a what? They put them on, generally people, they will classify them on operating expenses. These are not operating expenses. Rent, rents and insurance.
Profit or loss.
P and L. Postage, stationery and telephone.
Profit or loss.
Heat and lightning. Heat and lighting.
Profit or loss.
Advertising.
Profit or loss.
Then salaries and wages.
Profit or loss.
Profit or loss.
Bad debt.
Profit or loss.
Cash in hand.
Financial position.
Cash in hand.
Financial position.
Statement of financial position. Cash at bank.
Statement of financial position.
Profit and loss. Bank. Cash at bank.
Statement of financial position.
Inventory. Opening inventory. 1 January. That's, we look at the date.
Profit or loss.
P and L. Trade account receivables. Account receivables. These are data.
Statement of financial position. Statement of profit.
Fixed and fittings.
Statement of financial position.
Depreciation. Depreciation.
Profit.
P and L1 is Then
Profit or loss.
the assets, depreciation, P&L. Then the assets, fixture and fittings. Fixture and fittings. The asset is what? F what? P. Provision for depreciation. So here you need to calculate depreciation. Calculate. Yes, calculate depreciation. So here we are saying calculate what? Depreciation. Here. Then the remainder, the current amount is transferred to S statement of financial position. Provision for depreciation for fixture and fittings. We don't take this figure, it's not going to be taken like this, but we are going to use for calculating the current amount for that period. Depreciation expenses given 12,074. All right, then additional information. The one who was reading can continue reading on additional information.
The slide has not yet appeared.
It's not
Okay,
appearing.
additional information. At the following additional information as at 31 December 2021 is available. A. Inventory at the close of business was valued at 17,750. B. Insurances have been prepaid by 1,120. C. Heating and lighting is accrued by 1,360. D. Rates have been prepaid by 5,435. E. The allowance for doubtful debts is to be adjusted so that it is 3% of trade accounts receivable. Thank you.
Okay, thank you. I'll come back to let me try to. So you need to discuss on how do we do with those adjustments.
What is it?
Okay, can we discuss on how I'm going to do with this?
Additional information A. That means closing stock.
Closing stock. The closing statement of financial position. Insurance.
Insurance expenses. Of which you have prepaid. Prepaid expense, no.
Statement of financial position. See. Prepaid expense. Prepaid expense.
Okay. Okay, inventory, close of business, that is a closing inventory. Insurance has been prepaid by 1,120. The insurance, that is a what? It's a current layer, it's a current asset. CA, let's indicate it by CA, that is current asset, because you paid in what? In advance. That's prepayment. Accrued, it means you are owing. You've got an obligation to pay, that becomes a current liability. So let me present it, current liability here. That is a current liability. So which means that there are some current liability here. And again, this one, it increases expenses accrued by, that is the current liability. So this one is a current asset, and therefore reduce, you need to reduce the insurance. This one, you need to increase, the heat and lightning, that is heat and error. Rates have been prepaid. This is a prepayment again. So prepayment is a current asset. This is the current asset for prepayment. Then prepayment, that is a current assets, and these current assets, it reduces insurance on PL, on profits, on P and L. This one increases current liabilities, increases the heat and lighting on P and L. For P and L, I'm saying it's profit and what? Loss account. And then rates have been prepaid by 5 what? This is the current assets. Then you are going to say prepayment, so reduce rates on PL. Therefore, reduce rates on P and L, because they paid, because we are using the matching concept on P and L here, because we are using the what? The matching concept. The matching concept should match the revenue generated during that particular period with the what? With the expenses incurred during that particular period. We are still here. The allowance of that for debt to be adjusted so that it is 3% of trade account receivables. So this one you adjust on the what? It reduces, this one reduces our account receivables, reduces the account receivables. It reduces the account what? Receivables, and increases the expenses on that. Anyway, so these adjustments usually they carry what we call big marks. So big marks, usually you are going to get big marks if you do well on these adjustments. Then you are poised for massive victory, because this usually they will sometimes 2 marks or more than that. Then required to key statement of profit or loss for the end 31 December and statement for financial position as that date. 20 marks. We go here. We have got cells here. We pick cells. That's 25980. Let's return inwards 5624. Then you've got revenues 254246. All of these sometimes these are the now revenues which we are supposed to recognize, to record in our books of accounts. That is 254246. So you find out that here, because we have got what? We've got return inwards. So return inwards, like what I said, they reduce what? The sales. Then cost of sales, that is opening inventory. This one is as at the beginning of the year. At the beginning of the year. At the beginning of the what? Of the year. That is what? It's the closing balance for the previous what? For the previous year. Okay. Then you have purchases. So it's opening stock, 8 purchases. Purchases there on the trial balance. Carrying inward, that is on the trial balance. Carriage inward, like what I said, you don't write carriage inwards on the what? Some of you, they've got a tendency of writing carriage inwards on the operating expenses. Carriage inwards is not an operating what? Expense. But what this one, it reduces what? Purchases. It's only included in the what? In the gross, it's only included when you are calculating in the trading account. It's in the trading account that the carriage inwards. But carriage outwards is an expense. For example, labels will incur some Then let's go on to the next chain. So carriage inwards, we add it. It increases the purchases. Be very careful on this one. Then return outwards. That is 13,407. Then close the inventory. That is you subtract what's it? The opening inventory, add it. Then cost of goods sold, that is 132,007. I think this one is clear. But to understand this, going to say your opening inventory at the beginning is going to be increased by the purchases, what you purchased. Then also increased by the expense of carriage, what inwards, when you're bringing the goods into use. Then closing inventory, that is at the end of the what? Of the year. Then cost of sales, that is what? Cost of sales. Then you what? You do the computation here, the calculations. Non-current assets return fittings, because they are saying the cost of an asset here, we pick here, fixed and fittings is 12,0740. Then you've got the provision on fixed and fittings as at 31 December 2021. Then we check here to say we need to be very careful here, because our books here, what they are saying, it was 31,021. So don't even need to calculate. We just subtract the current amount of 12,740 minus 63,020. Because at 31 December, which means that we want something for 1 January. So don't even need to calculate. Those were given. Okay, let's go on the next. So after you've done that, then we go on to The next one, that non-current assets, we say cost minus accumulated depreciation. Then you get what? We say cost minus accumulated depreciation. Then you get 57720. Well, this one you are given, and this one you are given. Heat and lightning. These are, but only on the accrued amounts. The accrued amount they need to be reworked. For example, I
Sorry,
say,
can you change the screen? We are not seeing where we are calculating the depreciation. Thank you.
you are not seeing it.
Yes.
You can't see.
Yes, sir.
The screen is not yet displaying where we are calculating depreciation.
There is no way it's written N3.
Yes.
You can't see.
We are still on N1 and N2 on the display, sir.
There are two here.
Yes.
Oh, Mama kuiona. Mama kuiona manje.
Yes, it's now visible.
Don't network here is slow, and it. Okay, let me wait for you so that you can able to access it, all of you.
During a group, during an online lesson, when the teacher asked me the answer, and I started to say the network is the problem.
Kusenga wachidzoka pa.
Vantu mawadzinga mdodo wadzoka chitei.
Anga wachidzoka tozoenda pa TikTok manje.
Kuita noise.
Handisi avapo.
Yeah, I think it's good to mute unless we are contributing something. It will give order in the classroom. Thank you.
Okay, it's now clear. Number 3. And
Yes, sir.
network is slow, very fast. Okay. When we answer cable, non-current assets. We say depreciation because this one we're given that it was the accumulated depreciation year which we're given here was at 31 December. So automatically it means we don't have to calculate anymore because we are given at the date. But if we're given at 1 January, we're going to calculate for the year, then we add plus what? That one which we brought forward plus the current one. But here, because we are given, so we have got an advantage. Heat and lightning. Heat and lighting. Given accrued heating. Here, because we should understand on this situation, we have got a heating accrued 1,360. So accrual is a liability. It increases the heat on light on this. So that's why you find out that here it was added, this 1,360. We will come here, then we take heat and lightning, heat and lightning. If it was 1, 1, 1, this one, then you pick it, heat and lightning. You come here. If there is any, then I will do this. I will paste heat and lightning. Then plus, because they are saying from these notes, the heat and lightning is accrued. Then I'll pick this 1,360. Then we add here, because I had not paid, but I should have paid. So the making concept will say, if you have not paid, it means you should what? You should cater for it. We should cater for it here, because, so if we add this one plus this one, we get 1, 2, 3, 7, 0. These are big marks, because you might find out that it's got 1 mark, maybe this one is got half mark. So these are big marks. Some of them might have mark or a quarter of a mark. But if you are doing well with adjustments, you get big marks. Then we check again the other one, insurance prepaid. Prepayment, I said prepayment. It's you reduce it. So if you come here, prepayment, it was on a insurance. Insurance, that is prepayment. So prepayments, usually, that's why you've got rates, rent insurance. That was 25973 plus insurance payment 1120. What we do when we have got a prepayment, it what happened? It reduces our what? It reduces our expenses. So the prepayments here, there were two. There was insurance 1120 here. It reduces this amount. Rates, and insurance. The rate per repayment was 5435. This figure was obtained after adding the rate, and insurance. The rates here, rate insurance was 25,000 here. 25,973. That is 25,973. 25,973 here, plus the insurance prepayments. Well, there was insurance prepayment of 1120. A prepayment, if you prepay, we subtract. If you prepay, go the rate insurance, it means we paid in what? in advance. Then there was a rates prepayment. This were disclosed separately. We need to be very careful because here, rate assurance, they've got this 25,000, but here, if you check here, there is a clause here of saying insurance have been prepaid 1120. Then rates, but they are under the same heading. So on the prepaid, what you do in the prepaid here, so you subtract 1120 and you subtract 5435, or they are on this under same headings. That is where we are here to say 1120 minus 3435. Like here, accrual heating and lightning 1360, it gives you 12370. So this marked is 0. They are what? They are deductions. Are we together? Then at the end of the day, it means the entity should also, which means that Toki has got only an expense of 19,118. For this one was prepaid, was paid in advance. Because we should use the matching concept when you are preparing the what? The profit and loss account. Any question? Any question? Okay, let's go on the next 6. Allowing for doubtful debt. That's 3%. What you do here, that's the 3%. Allowing for doubtful debt, 512 increase. Usually, what is happening here, you've got a scenario whereby here you've got the allowance which are given, which had been already provided by the entity or the company. So here the allowance which is already provided in our own case, that is an allowance doubtful debt. You've got 1,000. So we have got 512. That is we already what provided. But here we are saying, if you got the additional information here is saying the allowance 3% of the trade account receivable. So we say 3% of the account what receivable, which is the 3% of account receivables. Here that is accounts receivables. Here, where is it? Receivables, account receivables, for trade receivables. So we say 3% of 2,450. Then we compare which one is bigger than the other one, which one is greater than the other one. That is what you then we subtract to get what the increase or decrease. On this situation, what happened was that they allow 3% of the allowance 7,450 of the trade receivable is 735. So the net trade receivable is now 23765, which is supposed to be recorded in the profit and loss account under current assets. But here, 735. So we compare 735 and 512, which means that there was increase in allowance. So there was an expense. If there was a decrease in allowance, this will want to be what? An income. So you need to be very, very careful on this one. You don't write 735 or to write 512 provided on the trial balance. What you need to do is to adjust to compare the one which they provided this year. For example, they provided what? 735. Then you compare 735 plus the allowance which has been what? Which is already there. So increase in allowance for doubtful debt, that is towards 223. So the increase will be recorded in the white profit and loss account. Only the increase. So we compare these ones. The one already provided, that is 512, and the one which we calculated during the year, which was provided 735. So we say no. So provided a higher figure, so there was an increase. What said already been what provided. So it means the company or the entity in case is 223, that becomes our expense. So you need to understand to pick the total account receivable. Then you say 3% of that, then you get 275, 35. Then you compare this one plus what? Allowance for that what? Okay. And allowance for that for debt, 3% in the current one. Okay, then you go on the statement of financial position. Statement of financial position. Hey. If you don't want to learn, can you, order. If you don't want to learn, can you move out quietly than disturb others? If you don't want to learn, can you quietly move out and mute? I know it's lunchtime, but the timetable speaks that we should be doing this lesson from 12 to 4. So if you finish earlier, the better, because this will allow us the time to do other business, to do other works. And again, we don't know with the issue of power. Power can maybe sometimes don't have electricity over there. Your mobile gadget might end up not having power. So we should utilize this time effectively and efficiently. So let's go on to this one, statement of financial. Let's go on to this profit and loss. So here in the statement of profit loss comprehensive income here, what you are going to do, you say on December 2021, revenue N1, we've talked about it. Cost of sales N2, talked about it. Other income. Discount received is another income. Discount received is other income. Then total what? Revenue. Operating expenses are left for that for debt, which we want to be adjusted to find out the amount brought down and the current. Discount allowed. Discount allowed for an expense because you are giving your customer a discount. Carriage outwards. It's an expense because, for example, when Lobels or Baker Scene is transporting bread, distributing bread to various areas, they incur some few expenses, motor vehicle expenses, and everything. Okay. Postage, written lightning, written reassurance, we've calculated it to say if there is a prepayment, what do we do? If there is an accrual, what do we do? Advertising, salaries, wages, bad debts to pick as they are. Then depreciation, bad debts now in those words, people they are no longer going what to pay. Depreciation, we pick what we from the what we from the we pick out what we are given on the trial balance because it was at that date of the closing the closing date. Then statement of financial position, fixed and fittings. We calculated it when we are saying the cost minus the accumulated depreciation. Then inventory, want the closing inventory. Bank the same, case the same. Account receivables. Account receivable that you're supposed to do for calculation of what? That's for debt. So this one, what you do to account what? Receivables. You say that 3% of the amount which is there as inventory by that time. Insurance prepayments. That is 1120. Account receivables. As we said earlier. Rent prepayments. These are all current assets. All the prepayments are current assets. Then insurance prepayments. Sometimes you can add these ones as there are 2,1120 plus 5435 here to come with the total of what? Of prepayments. So prepayment, they fall under current assets because that is the what? That's your resources. You can have the significant influence on them. Total assets, then you add actual liabilities, equity. That's the amount which is invested by the owner of the business. Then capital. Then capital amount invested, net profit. Profit which you are going to get on the statement and profit loss account. This profit, it will be carried again to what? To our okay. So we are saying here profit which 2417 here. That's the profit which you are going to add again here. This one. So the profit, so if your figure is wrong on the profit and loss account, it means here it's going to be wrong the same thing. Then drawings reduces capital. That's why they are there. They reduce the owner's equity capital. High liabilities, trade accountable payables, 1940. Accrued expenses, detailed lightning. Detailed lightning, those are accrued expenses. Payables, it's a short-term loan. Then total equity liabilities 110765, and here should be what? 110765. Any question? Any query? Any question? Any question? Any question? Let's see, interact.
No question, sir.
No question. Okay. We don't want to leave any stone unturned. So we don't want people who cry foul to say we don't know this. Then I want us to look on some of the keywords here, which are very important when you're preparing financial statements. That is our last one here. We want to look on the issue of which are very critical, the fundamentals of that is the fundamentals. We have got what we call reliability and relevance. These are the key fundamentals for reliability and relevance. So when you are preparing financial statement, you should understand of that. You say relevant, it means there should be a predictive value for the feedback value for somebody is preparing your statement should meet that standard. So when you are preparing this one, should have what we call that predictive value. It means what you are saying, the value for the future planning is going to be relevant. So, and the liability you are saying, the information is free from what? Bias. And the information is free from bias. The information should describe the proper accounting and economic phenomena without what? Any problem. That is the reliability. People should not question its credibility. So you should understand those things to say reliability and what? And the liability. So other fundamentals are then matching concepts in the profit and loss account. Because matching concept, we are saying that's why we are using, we put accrual for prepayment. They arise because of that. Because we are saying only revenues and expenses engaged that particular period should be expenses. Okay, any other questions? Any other questions? Any questions? Manzwisisa. Alright, notenda kamanzwisisa saka ndichakutsagirai kahomework kamuneisha. Let me check here for my group.
Homework.
Homework. Mofunga kuti homework inopuwa neprimary chete. Any very
big.
Let me go here, then that is
This